Okay, welcome back to the ICT course. This is going to be the final video of this short course series. Maybe I'll add some more, but for now, this is the final video summing up basically all the concepts and how you can use them in one video. And so it's going to be on all the fundamentals of the ICT 2022 mentorship model. And before I get into it, as always, just want to give credit to ICT himself for all of the concepts he's taught and this model that he's come up with. So if you want a deeper understanding, longer videos, more in depth, check out his channel. Lots of good content there. We're getting straight into it then. So the checklist that you should follow when you're trading this model is this. These are the 6 steps. So first, you're going to need your daily bias. Then you'll look for areas of liquidity. Then you'll wait for liquidity sweep, followed by a market structure shift with displacement. Then you're going to enter on a pullback to a fair value gap, the FVG. And then you're going to decide on your stop loss and take profit placement. And I'll go into in-depth in all of these 6 points. So first up, your daily bias. This should be determined from the weekly chart, then the daily chart, and then the 4-hour. This is what I do, and so feel free to experiment or do whatever you prefer. This is just the process that I follow. And then on each time frame, what I'll do is I'll mark up order blocks, fair value gaps, and any liquidity draws, and then I'll also label everything that I mark with whatever time frame it's on, so that I can distinguish, between a weekly order block and a 4-hour order block. So it just gives you an indication of the strength of the zone that price is currently in or heading towards. And I'll just go into a quick example now on the E-mini futures. Okay, so I'm just going to go through this example. It is from a while ago. I used it myself on this week, 31st of July. On the Monday, I actually got a trade entry from it, but otherwise it is just going to look like I'm doing it in hindsight, so it will still be useful, but just remember that. So the first thing I saw when I was looking at it after this week, the 24th of July, was that price had just come up on this key high and swept liquidity, just about swept it. And this is one of the things I said I'm looking for when you get in the daily bias. Look for liquidity sweeps. There wasn't any imbalance, so I wasn't looking for that. Nothing up here to look for. Potentially this order block, but there's no imbalance after it, no FEG after it, so it wasn't as important, so I didn't mark it up, but I'll leave it there for now, just in case. And then on the below market price side, there was this little bit of imbalance, FVG here, that could have marked up, so I will just mark it up now, call it a weekly FVG, bullish one. And so that's what I was looking for on the weekly time frame. Pretty simple. Then if we go to the daily, I did actually add a daily FVG here, see if price would react from there, as well as a daily FVG over here. So 2 things, just mark up anything you see, but the main thing that I was looking for was this liquidity sweep, which you can't really see anything to trade from currently, but then when I went down to the 4-hour time frame, you could see some clear FVG and order block. So this is what I look for an entry from. And price came in and then on the Monday tapped into it in the New York session and then pushed down for the next week. So this is kind of the 2022 mentorship model on a higher time frame. Now you've got your liquidity sweep, you've got your market structure shift here. Daily bias kind of ties in with the liquidity sweep, and then pull back to an FVG or order block, and then take price down to this point and any opposing liquidity. And that is something else to note. My daily bias mainly came from, or just my bias in general, not daily bias, but just my bias in general, came from the fact that when we were up here, my next draw on price was this weekly FVG, and then going down to the daily, there was more FVGs, more fair value gaps that price would likely be drawn to, and as you can see, it was played out perfectly. Price was drawn straight to it, little reaction, straight to it, little reaction, and prices just push through. So my bias was right. Once we had this liquidity sweep of the weekly high, price just took off down. Okay, sorry to interrupt, but I'll try and make it quick and useful. I've started a premium Discord group if you do want to accelerate your trading journey, and I've got a few different options that, depending on where you are in that journey, you can take. So firstly, I've got a monthly mentorship where I do weekly calls, give you my trading setups, as well as support from me, and a strong community of determined traders for just $5 a month. I've also got a complete SMC course with everything that you need to know in one place, as well as the strategies that I trade on funded accounts with proven results. And it also comes with a free 30-minute meeting to accelerate your trading journey and fix any issues you have. And then finally, if you want a more personal approach, then I have a few spots for one-to-one mentorship with monthly or more regular calls and unlimited, pretty much 24/7 access to me. Any questions you have, just send them my way, as well as a tailored learning path that I will create for you to get you profitable. So thank you for listening to that. Definitely check out if you're interested in any of those options, and let's get back to the video. So then the next step was areas of liquidity. And so as for the areas of liquidity, some things that you should be looking for and marking up are previous day highs and lows, previous session highs and lows, equal highs and lows, as well as key swings. And so once you've done this, something you might look for, as you can see in the picture there, the line drawing, what you might look for is the sweep of the previous day high before running to the previous day low. If you have a bearish bias, you can look for the previous day high to be swept. Look for your entry there, take price down to search for the opposing liquidity, in this case previous day low. That's just an example. This is just textbook setup, so not going to be perfect like this in the charts, but just something to look out for and have in the back of your mind. Okay, so next is the liquidity sweep, and something that I really want to stress is just be patient, as the liquidity that you've marked up, it won't always be swept. So don't let yourself give in to FOMO, fear of missing out, and enter impulsively. And one way that you can do this, and one way that I do it, and I think other people should, is by only acting on liquidity that you've already drawn up before your session starts. So don't add anything after, don't look for maybe some liquidity that you might think has been engineered during that session. Just look for any liquidity in the past when your session starts. Focus on past liquidity. Also, if you're bullish, you're going to be looking for sell side liquidity to be swept. And if you're bearish, you're going to be looking for buy side liquidity to be swept. So that's pretty simple, but just make sure you're thinking about that. Next then is the market structure shift. And again, ideally with displacement, where displacement is an energetic move after breaking structure, or more applicable here, I guess, is after a market structure shift, which is just a shift in market structure from bullish to bearish, or vice versa, because that's going to give you a clear indication that liquidity sweep has been accepted and the structure is now changing to being in the direction of the bigger move that you want to catch. So again, I'll go into a quick example here on the E-mini futures, just so you can get a better understanding of what a market structure shift and displacement is and how you could potentially use it in the model. Okay, so I'm just going to be going through this example then for the market structure shift and displacement. This is the area I'm looking at. This is during the New York AM session. If we go to London, you can see that quickly there was also a market structure shift. You got bearish market structure. Once this high gets broken, you got bullish market structure, and you got some displacement. FEGs forming strong bullish candles, and then when price returns to this zone, it does give a small reaction. You could have caught a small move from here. Didn't break structure again, didn't push past these highs, but it did form a small reaction. So that's kind of what you're looking for. But the trade that I was looking at, what you can see here is that you do get your sweep of liquidity, and then you get a market structure shift, which occurs either here, if you want to call it that, or more strongly, high probability trade here, when this structure gets broken. You've got your bearish structure, lower high, lower low, and then price pushes up. Some people would also call this, your high, low, and so you could call that market structure shift. This is all going to be up to you and your discretion, but for the higher probability, wait for the key structure to be broken. Then marking up your displacement, you can see displacement occurs here. You've got strong consecutive bullish candles, no pullbacks, just straight bullish volume coming into the market, and it leaves behind some fair value gaps. You've got this one here as the extreme one. The price does fill before pushing up, and you could have also marked up something like this and caught a quick trade here. You could have got your entry, pull back to this fair value gap, stop loss maybe below there, and target 10 handles or whatever. You could target this liquidity here, or you could look back and try and fill all this imbalance. Whatever it is you want to do, it turns out that even this liquidity up here got taken. So whatever you want to target, that's up to you. This is just about entries for now. Could have taken something like that, or even though this imbalance was filled a bit, the FEG, it wasn't fully filled, and so you could have got an entry, something like that. Stop loss, probably quite a big stop loss below there, and target these highs, and that's a 1 to 3. So a very nice trade that you could have taken with this displacement. Hopefully that gives you a better understanding, and we can move on. So then for your entry, you're going to be entering from the FEG, the fair value gap. And as I spoke about in the video on fair value gaps, you can either use the start of the FEG, the 50% level, an order block, or whatever you like. But if you're not sure, then I would suggest just using the start of the FEG. You're going to get tagged into more trades. You won't have psychological issues of FOMO because maybe your entry is a bit lower down or higher up, depending on if it's bullish or bearish. And sometimes you'll miss those trades if you're looking for a 50% entry or a more advanced entry using order block, breaker block, or whatever. Another thing is that you can also use it together with the optimal trade entry. So if you haven't watched that video, definitely check it out. But effectively, it's just the 0.62 and 0.79 Fibonacci levels. So use those two levels, look for a big retracement into the zone. If it lines up, you're good to go. So then for your stop loss, you could either place it right above or below the first of the 3 FEG candles. So if you just go back here, you can see, looking at this bearish example, you can see the FEGs here, you've got your 3 candles, 1, 2, 3. You can place your stop loss above the high of this candle. That's a potentially safe place to put it, but if you want to be even safer, what you could do and what I would suggest is put it above or below recent structure. So I'd say do that to start out with. You'll be a bit safer. Yes, your risk rewards might be a bit lower, but you'll get taken out less often and you'll grow in confidence in the strategy. Then for your take profit, it should be at opposing liquidity, but something that I've seen is that most trades will hit 5 handles for indices, futures and stuff, or 10 pips for Forex. So those are good points for first targets. And what you might want to do is close some here, at the 5 handles for indices or 10 pips for Forex, and then let the rest run to the opposing liquidity if you want. So you can secure a bit of profit, maybe move it to break even. I probably wouldn't recommend that, but you could do something like that and then target the opposing liquidity as the full take profit, or you can just target either one as the full take profit. You could target 5 handles, 10 pips as your full take profit, or you could target the opposing liquidity as your full take profit. Up to you. So now getting on to an example, this is just the textbook setup, and then we'll get into a chart example of a trade I took. But as you can see here, you've got a bullish bias, which is the main thing, step 1. Then you've got some liquidity, some equal lows drawn up, which do get swept. This is followed by a market structure shift, showing that we moved bullish price action. Now after the liquidity sweep, showing that the liquidity sweep has been confirmed. And then we're going to just assume that there was some displacement and a fair value gap here. Obviously you can't tell because it's a line graph, but we're going to assume that. And then you would enter on the pullback to this zone. You can place your stop loss below the liquidity sweep, which is a nice place to put it. When I was talking about putting it above or below recent structure, sometimes the most recent structure will be the liquidity sweep, which just makes it 10 times easier. And then you're going to target the opposing liquidity, equal highs, nice place to target. Sometimes there might not be a perfect place to target, and in this case you can, here you can target this swing maybe, or you can target the 10 pips, 5 handles, whatever it is. But yeah, this swing is also normally a nice point to target. The swing after the liquidity sweep, so you can see liquidity swept, you get this leg up, pull back, target the high of that leg, or low if it's reverse setup, because that's a nice place that will often get tapped into and taken. So now a real life example of a trade that I did actually take. So my bias was bullish. Again, keep that in mind. We're not just trading random liquidity sweeps all over the place. My bias was bullish. Yes, price was coming down, but my higher time frame over here, you can see price bearish, but my higher time frame bias was bullish. So I had an expectation that price would continue up, and so I can look for longs on the lower time frames. And then what we had was a liquidity sweep just of this previous day low. So as I spoke about that, you can use that as liquidity. It doesn't have to be equal lows or anything like that. Just previous day low was enough here. Got swept, and there was some opposing liquidity, trendline liquidity again. Maybe not your perfect liquidity, but there's some trendline here, and it's going to be liquidity resting not just above the trendline, but also above all of these highs to get taken. And so something that you might be confused about, I guess, here is where to target in a trendline liquidity sweep. And to be honest, that's discretion. It's going to be up to you. Safest place would be the first week high. You can target here, and the best place is up here because it's likely that this will get taken as well. Maybe it won't, but it's likely that it will, and it gives you the best risk reward. So even if you might miss out on a few trades, you might lose a couple extra, the risk reward should make up for it. So I would recommend targeting the highest high of the trend line. So then once we've got a sweep of liquidity and a market structure shift, I looked for entries, looking for FEGs. And although my entry was actually from the order block down here, see this last bearish candle before the move up, you could have got an entry from the FEG like I've shown here, taken it up. I managed to get a higher risk reward by sacrificing some trades that I would miss because they won't always come back to the order block. But yeah, I got my entry here. As you can see, price reacted from the FEG, took off. I might have missed my trade. Price could have just continued up, but I did luckily get a return to the order block, and then price took up again, hit my take profit. Yeah, that's it for this chart example, and that's it for the video. Hopefully you've learned how to use the 2022 mentorship model. If not, then maybe rewatch the video, and if you still don't understand it, either send me a message on Discord, leave a comment here, and I will help you out. And if you still can't help you understand it, maybe watch ICT, because there's a lot of good stuff there. It is a big commitment. The 2022 mentorship is a long course, but you'd happily go to university and spend all this time revising and learning. So why not do it for something that's going to change your life? You know, that's the way I see it. And definitely, if you put in the effort, that's how you get results. There's no get rich quick. It's all about putting in the effort, and then over time you will see results. That's just how it works. But hopefully this video has been helpful, and hopefully this whole course has been helpful. So if it has, please do leave a like. Go back, leave a like on all the videos if you want to. I'd really appreciate that. But just let me know how you found it. Hopefully it was good. And thank you for all the support. You know, it's been great. And I hope you have a nice day. But thank you for watching, and I will see you in the next video.